I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. They're not evident right now to most people. All they're focused on is AI. I expect silver maybe be $200. That fast. And people are looking for normality. Like, oh, we go up 4 steps and pull back 2. Go up 3, pull back 1. All that nonsense. The norms will be shattered. And you'll go into a new reality. And yeah, you'll get a sell-off at some point, but it's likely to be in a reality that possibly even overshoots what a real price conversion of silver would be, factoring in the decay in the value of the money unit, the dollar. Not versus other currencies, but its real value, the quantity of dollars, the M2 chart. I think this time around in the major markets of the world, gold being one of them, the monetary metal been around 3,000 years, silver as well, that the ongoing process we've had for about 100 years now, one long human lifetime only, of the Fed, one, having monopoly control over the quantity of money and a monopoly control over the pricing of money. Okay. Now, if you had that over, let's say, the price of corn, and the government said, okay, corn's essential, we're going to take control of that market. We're going to determine the quantity that's produced every year and the price we're going to sell it at. Well, people would say, well, that's socializing the ag industry. It's what Mao Zedong did. They gave that up in the 1980s in China, by the way. They privatized. But nobody comments on that. It's an inefficient way for the most essential commodity between human beings when they make a transaction, whether they know each other or they're separate parts of the world, to be distorted by a central bank. Well, if that is not causing good effects, boom and bust cycle after boom bust cycle, and it's going on in Japan as well and in Europe and so forth, there's a point at which people finally say, hey, I had enough of this. It isn't working, especially if you inflict pain on them. And I think if you take that stock market down, and we think it's in a topping process, it has been since early this year.
While stock markets push to new highs, warning signs mount beneath the surface. Consumer credit has surged, delinquencies are climbing, and millions are falling behind on taxes. Debt-dependent households are already struggling as living costs rise faster than wages. A sharp market downturn, similar to 2007-2009, could inflict damage far beyond Wall Street. It is under these conditions that political frustration grows, institutions lose credibility, and academic voices re-emerge with old but powerful ideas, that the long experiment with purely fiat money may be reaching its limits, and the world could be heading toward a monetary reset anchored in real assets.
New highs don't change that. Our momentum work says momentum is peaked, price is waiting, it usually lagged the momentum. But if that guy goes down and you start to get the wave effects in the real world, like we did 2007 to 9, if you'll recall, people that weren't even in the stock market were hurt badly. You inflict pain, people are already hurting, we know that. Consumer credit's maxed out. The number of card delinquencies is exploding. Failure to file tax returns, et cetera, et cetera. You take that market down and the real world consequences get worse, you're going to have people throwing their arms up in the air saying, gee, neither party seems to work. What do I do? And that's when academicians come in, and they have influence because they often are brought into the government as well. They'll say, hey, this central bank thing, this hasn't really been working like we thought it would. Instead, it creates boom busts. So you could end up with a situation this time around where gold goes up and becomes monetized, silver with it, where suddenly you go to a new price level, not just because of industrial demand for silver or anything like that, or repricing it out of an old reality into a new reality. We can get onto that in a minute. Where bigger decisions are made such that when gold goes up next time, all of a sudden this country, that country, that country, that country. No more fiat currencies backed by real stuff. And that could be the outcome of this move. So this stock market move, this gold move, commodity move, all the things we can talk about here shortly, could be different this time. They're likely to be in terms of significance.
If confidence in conventional monetary systems breaks down, nations may consider alternatives that tie currency to tangible value. Central banks have already accelerated gold purchases since 2022, marking the fastest accumulation in over 50 years. Under such a shift, gold and silver wouldn't rise merely on investor demand, they would be revalued to reflect a new monetary reality. Past U.S. bull markets saw gold rise eightfold from major lows. Given today's unprecedented debt levels, geopolitical tension, and inflationary pressure, a similar move could be modest compared to what might emerge if countries collectively pursue commodity-anchored currencies.
I'll give you two examples. You only have 50-year history. The U.S. government legalized it, okay, January 75, okay. Over that time, there have been two major bull markets. And if you measure from the bear low that preceded the bull market to the bull market peak, bear low to bull peak, both moves, one peaked in 1980, one peaked in 2011, were eightfold moves. Not the same dollar amount, but the ratio move. The same dimensionality of price gain, eightfold, bear low to bull high, okay. We're only fourfold. We started from a bear low at 1,050. Multiply it times 4, okay? You're a little bit better than half the dimension of those two prior bull markets, which were of different duration, by the way. One was about 3.5 years, one was about a decade, okay? So I'm not counting the years, I'm just saying how much did it move? And it moved under circumstances then that are by no means as dynamic pending as the ones we're sitting on right now. So I expect gold to go to 8,000. That's just matching the old highs, though. That's not even abnormal. That's like saying, oh, I did it again. How about we go a lot further than that? Don't be surprised. Like 20,000, whatever. Again, it's going to depend not on so much the technical dynamics of gold when you do swing measurements or anything like that. It's going to be on these other factors that suddenly cascade into play. They're not evident right now to most people. All they're focused on is AI.
For decades, analysts have debated whether major banks suppressed silver prices, especially after several institutions were fined for market manipulation. Despite this, silver's long-term fundamentals are strengthening. Industrial use, from solar manufacturing to electronics, continues to soar, and supply deficits have widened for 3 consecutive years, according to the Silver Institute. Historically, silver's performance relative to gold has signaled explosive moves. Each time the silver-to-gold spread broke key resistance levels, in 1980 and again in 2011, silver entered a rapid surge. Recent charts show that this spread is once again approaching a breakout, hinting that silver may be preparing for another dramatic acceleration.
But if all of a sudden other factors come into play, especially negative ones, hands go in the air, emotions occur, politics becomes dissembled, which it's already become. I mean, the two parties are fragmented internally, getting worse even on the GOP side's fragmenting. Suddenly, people don't have a sense of, it's 52-card pickup. And there's one thing they can rely on, like their granddad told them. Keep those gold coins, those silver coins. Okay? Yeah. And all of a sudden, those monetary metals are, again, monetary metals. All kinds of factors like that. But as far as I'm concerned, just as the U.S. government and their central bank, just like the EU and Japan, don't control reality. So even if they set a price, I don't care. It doesn't mean it's going to stop there. Okay? They don't fix price. They may try to. I mean, there's some solid arguments that they've been manipulating silver. We need to get onto that, too. And capped it off for the last 50 years. While copper and lead have quadrupled. I'll get into that in a second. And suddenly I think silver is about to leave and overrun that attempt to control the price of silver. And we know some of the big banks have been manipulating silver. In fact, there's been a couple actual criminal convictions in that regard. But if you want to, we can get on to that next subject. And you've got the spread chart of silver versus gold.
When silver breaks long-term ceilings against gold, the reaction is rarely gradual. In 1979-1980, prices quadrupled within months. In 2010 and 2011, silver more than doubled in less than a year. Today, the metal sits near only 1.2% of gold's price, well below the 2% levels seen in nearly half of the past 50 years and far beneath the 3 to 3.5% levels reached during major bull peaks. A return simply to historical norms would imply a dramatic surge. But given the scale of monetary distortion today, the next move could overshoot even the previous extremes, driven by both financial stress and structural demand.
This only goes back to 2020. Okay, so 5 years. We know in early 2020 and to late 2020 and early 21, silver exploded in price. And therefore, the spread chart showing an ounce of silver divided into an ounce of gold was under 1% then. It was under 0.9%. Divide an ounce of silver, an ounce of gold. It shot up to over 1.5%. That's a huge percent gain. It's like buying a stock at under $9 and it goes over 15. Did it in like 6 months. These are weekly readings here, by the way, week to week. But then, since 2021, when silver was over 1.5%, which is still dirt cheap historically, silver to gold, it eroded. Now, price of silver is going up since 2020. We know that. 2020 was 30. We're now, $52, 53. So it's gone up, but its performance versus gold has eroded, meaning it's not gone up as much as gold from that point to the current level. Now, you'll notice since about March of this year, that thing exploded back up again. So silver's been outperforming gold for the last half a dozen months or so, gaining. But there's a green line on that top chart, the spread chart. If you can clear that line, this spread breaks out, and that line goes back over 3 years. Ceiling, ceiling, ceiling. It's called what you call a base, okay? You break out over that, it's a fresh buy signal, meaning time to buy silver rather than gold. Doesn't mean gold's going down, just means silver's going to beat it. So if you have the combination of that first chart, gold breaking out versus the S&P, what it's telling you is you want to be in monetary metals, not the stock market bubble. This chart says you not only want to be in monetary metals, you want to be in silver as opposed to gold, because it's going to beat gold. I'm strongly of the view, assessment, that when that first chart breaks out, gold versus S&P, as I said, it's already broken out versus the broader stock market indices. Silver's going to break out versus gold. And already this spread chart doesn't show where it is right now. It's up. It's moving up toward that green line right now. This chart's a week or so old, and we know a lot has happened in the last week. So that's another spread I'd watch, because it's not only telling you monetary metals are a place to be, but now you really want to focus on silver. Now, where might it go? If you go back 50 years and measure the peak point of where silver was versus gold each of those years, what was the highest rate, percent level, ounce of silver? 20 of those 50 years, it was at 2%. No, some of those years weren't even bull years. In fact, the bull years, 1980, 2010, 11, silver was up to 3.5% and more, the price of gold. But just routinely, 2% is not uncommon, 20 out of 50 years. Well, heck, right now you're at 1.27% as we speak. If it went to 2%, just a norm, well, that's a huge move. That's almost a doubling of the price of silver in relation to gold. So anyway, this is an area where I'm mostly focused personally in my investments, and they're exposed at the end of each report. I disclaim what I own. All my emphasis is in silver, sometimes silver calls, silver miners.
Silver's next move is unlikely to follow familiar patterns of slow advances and routine pullbacks. If the spread against gold breaks decisively, the metal may enter what analysts describe as a new reality, a price environment that reflects decades of currency debasement. Based on money supply expansion alone, a rapid spike toward $150, $200 is mathematically plausible. Such a surge wouldn't simply represent speculation. It would signal a global search for stability amid fractured politics, deglobalization, and loss of trust in fiat systems. Investors who wait for conventional signals risk missing a once-in-a-generation monetary reset already beginning to take shape.
On the cusp of a major reality, a new reality for silver. And I'm arguing it's highly likely to happen First off, if that spread chart I showed is silver versus gold with that ceiling goes back over 3 years. Boom, boom, boom. When you break out over that, same spread chart event occurred 5 months before silver reached $50 in 1980. It moved from the 20s, no, from the 15 level, I think it was. It's like a quadrupling in price of silver in 5 months. And the only technical we can find that said it's about to begin was not the bull trend in silver. It had already been going on. It had been going up for years. Suddenly it went electric. That spread broke out. 2010 and 11, silver had already been going up since 2000, 2001. And in 2010, in September, through April 2011, silver went up in that 7-month period, double and a half. Bam! The spread broke out first. That spread breaks out, we set the clock. And I'm arguing that probably in the next couple of quarters, remember the copper move and the lead move, and there's plenty of other markets that have done that, I expect silver maybe be $200. That fast. And people are looking for normality. Like, we go up 4 steps and pull back 2. Go up 3, pull back 1. All that nonsense. The norms will be shattered. And you'll go into a new reality. And yeah, you'll get a sell-off at some point, but it's likely to be in a reality that possibly even overshoots what a real price conversion of silver would be, factoring in the decay in the value of the money unit, the dollar. Not versus other currencies, but its real value, the quantity of dollars, the M2 chart, which is, goes up about 90% in supply every decade. Okay. And so being $200 might just remotely match the 1980 high. So, and I expect it to happen very quickly. And frankly, if you're not there, you're going to miss it. But don't use the normal tools. They won't work.